we see that achieving sustainability objectives is a key path forward, where there are a lot of interest in that and pushed by regulation, but also by intrinsic motivation from a lot of investors across the globe, especially what we see in Europe, but also Middle East, Asia, US, and Australia, New Zealand.
Welcome to The Greener Way. I'm your host, Rose Mary Petrass, Senior Journalist at FS Sustainability. We are recording on Gadigal land. We pay our respects to traditional custodians of country and elders past, present and emerging. Many in the investment community believe that implementing net zero policies comes with high risk and is incompatible with active investing. But is that really true? To discuss this, Guido Baltussen is here with us today. Welcome to the show, Guido.
Thank you.
Guido is Northern Trust Asset Management's International Head of Quantitative Strategies. Tell us about the paper you put out recently on carbon misconceptions.
Yes, it's a paper we recently put out in which we discuss many of the issues that we encounter with our clients or prospective clients and in general in the market around net zero investing. It's a key topic. Many investors are struggling with it. They question how to effectively embed that into portfolios. And at the same time, we encountered there are two common misconceptions, hence the title of the paper, Carbon Misconceptions. These two common market misconceptions are, on the one hand, that investors must accept a high level of active risk in order to be fully aligned with net zero. We dive into the paper. That's actually not the case. With limited amount of risk budget compared, for example, to a market cap weighted index, you can achieve quite much of the objectives put out in the net zero frameworks. And the second one is a net zero policy is incompatible with active or active factor investing. And we also dispel that misconception by showing you can build an attractive active portfolio or with a high factor exposure while being aware of the net zero framework and achieving those objectives as well.
Why do you think so many investors hold these views?
I think there are two primary reasons. First one is it's intuitive to expect that there is a lot of active risk needed to achieve the net zero objectives. Mm-hmm. There are a lot of ambitious targets put out there with respect to achieving net zero. And for many investors, that can come across as, okay, that requires quite some activeness on the portfolio and hence active risk. Mm-hmm. But actually what we show in the paper is you can achieve those objectives, but given that if your investment universe is broad enough, you have enough opportunities, there are many stocks with similar kind of characteristics with respect to sustainability and the net zero objectives.
Right.
By efficiently managing those, but also a lot of the risks that come along with it, you can still achieve quite a close and tight risk, do that in a close and tight risk budget.
Right.
The second one, I think, is experience. Because on the one hand, you have that intuition that these are very ambitious objectives in terms of sustainability. On the other hand, there are approaches out there that take them step by step in kind of heuristic approach. As a consequence, they onboard quite some, especially sectorial risk. A key example that many will recognize, for example, is risk related to energies. Mm-hmm. Of course, energy firms tend to have higher carbon emissions, but also are related to future carbon transition risk and other elements of the net zero pathways. Excluding a lot of energy names will introduce a lot of risks in portfolio because energy prices tend to be very volatile, especially lately, and can have quite some impact. Hence, you see in these more heuristic approaches that they take on a lot of these risks, and therefore you also see big return deviations from the benchmark. And that experience also, I think, typically triggers amongst investors that experience or that expectation that a net zero investing comes with a lot of active risk.
So do you think it's possible for a net zero policy to be compatible with active investing?
Yes. First and foremost, I think that what's very important when you invest for these net zero objectives and maybe some also for outperformance objectives relative to a benchmark, how do you deal with the risks that come with it? And how do you ensure that you have a very risk-efficient portfolio? Mm-hmm. We show in this paper that those three can be well balanced and aligned with each other, that you do achieve the net zero targets while maintaining enough activeness in your portfolio, for example, by means of factor content. And at the same time, do that within a limited risk budget.
Right.
We show that the net zero objectives can be, for example, met with 50 to 70 basis points of risk budget. And if you want to have enough active factor content in your portfolio by exploiting well-known and documented academic factors like lowly priced or value stocks tend to outperform the expensive stocks, winner stocks tend to outperform loser stocks, profitable stocks tend to outperform the less profitable or unprofitable stocks, or the quality effect. You can harvest these kind of effects. We show the case here for around the 200 basis points tracking our budget, where you do achieve attractive factor content to these kind of proven factors, and at the same time meet the objectives as put out there in the net zero pathways.
Mm-hmm.
The key for that, as mentioned, I think, is dealing efficiently with your risk. What we see happening is if you're not that much cognizant of the risk that you can take, that you onboard a lot of energy, but also sectorial risks in the portfolio, that you have a lot of sectorial deviations from the index. Typically, sectors are a key transmission channel for macroeconomic risks like oil price shocks to other commodity prices, shocks to interest rates into your portfolio. And these come with a lot of active risk that is typically less well rewarded.
Mm-hmm.
Or managing that tightly in your portfolio construction process, you can marry all three dimensions. So low active risk budgets, attractive factor content, and net zero objectives.
So how can investors apply conventional portfolio construction techniques to achieve net zero targets?
I think it all starts with that. If you think of traditional finance, I myself also am a professor in behavioral finance, financial markets, teaching these kind of concepts. And then it's about the first thing finance students get is the mean variance optimizations or mean variance efficient frontier. How do you maximize your return given a risk budget, or vice versa? Given a certain return target, minimize the risk that you can take to make sure you have an efficient portfolio.
Mm-hmm.
These kind of tools, together with advanced risk models, are available out there. And if you also act smartly in how you construct your factors and combine that, we can see that you can manage the net zero objectives and the factor content within a very risk-efficient portfolio within tight risk budgets.
Mm-hmm.
As mentioned, what's the key to achieving that? It's having a good, efficient risk model and embedding that well in your portfolio construction objectives.
Mm-hmm.
And in there, if the investment universe is broad enough, let's take MSCI World, where you have about 1,600 stocks. There are many stocks that are similar in terms of their risk profiles or fall within sectors like energy, but that differ widely in their sustainability profiles, like carbon emissions, future carbon transition risks, sustainable development goals that also signal aspects like what can be your net zero pathway.
Mm-hmm.
And by having that broad investment universe and enough stocks to pick from, you see that you can meet those sustainability objectives, avoid those names or underweight those names that come with a high active risk, but make sure you replace those stocks, for example, if they're from an energy sector or utility sector, with stocks from the same sector or that are close enough in terms of risk profile, but allow you to achieve the net zero objectives.
Mm-hmm.
And that substitution effect, that's quite important to manage your risk slightly.
How can investors achieve alignment with multiple sustainability objectives without taking on significant risk?
In our paper, we focus on, for example, traditional metrics like typically more backward-looking carbon intensity or carbon footprint metrics, where the carbon emissions on scope 1 and scope 2 of firms. We know in the net zero framework, scope 3 is also quite important, and that for some sectors can be overwhelming compared to the scope 1 and scope 2 emissions. We also incorporate those. Then we also look at things like future carbon emissions, carbon transition risks. There we do see there are a lot of different data providers out there which all have great approaches. but they also nicely complement each other, and you need to be quite cognizant of, if you take one particular data vendor, let's take carbon transition risk, there are approaches out there from MSCI, ISS, and other vendors.
Mm-hmm.
What we do see is that they can matter quite much in terms of their measurement across firms, and hence also the impact on the amount of active risk that they have.
Mm-hmm.
So in that sense, can you achieve multiple sustainability objectives? Yes, but you need to be very much aware how do you exactly measure achieving that sustainability objective? But also the other side, or what we call the double materiality, or maybe even triple materiality. How do you not only achieve the sustainability objective, but also the return and the risk objective?
Mm-hmm.
And how do you ensure you have the optimal balance across all those three dimensions? And that's quite crucial in embedding multiple sustainability objectives.
Mm-hmm.
That you know what each sustainability dimension is, that you know what's the best sustainability approach for that, but also what's then the impact on the risk and return on the portfolio, and how to find the optimal balance across three.
Is there anything else that you'd like to add today?
I think in general, we see that achieving sustainability objectives is a key path forward, where there are a lot of interest in that, and pushed by regulation, but also by intrinsic motivation from a lot of investors across the globe, especially what we see in Europe, but also Middle East, Asia, US, and Australia, New Zealand. What we see there is also that the field is rapidly evolving towards more and more sustainability objectives. It becomes more and more comprehensive. So from that perspective, if you also think of aspects like natural capital, biodiversity, sustainable development goals, to marry all these different objectives, we see it becomes even more and more important to ensure that you focus on building resilient portfolios that optimize sustainability objectives, but at the same time remain very much risk aware, but also return objective aware. Because in the end, investors also invest with the aim to achieve certain financial goals.
Mm-hmm.
And finding always that optimal balance between those three risk, return, and sustainability dimensions, we believe is key to achieving investment success and sustainability success in the portfolios.
Thank you so much for your time today. Where can people read your paper and also find out about Northern Trust's approach to sustainability?
Thank you. It was my pleasure. The paper called Carbon Misconceptions can be found on the Northern Trust Asset Management webpage. But of course, you can also reach out to your local representative of Northern Trust in your region.
Until next time, I'm Rose Mary Petrass, and thank you for listening to The Greener Way.
The Greener Way podcast is a product of FS Sustainability, a show about people, the planet, and investing in our collective future. All information in this podcast is for education and entertainment purposes only. The Greener Way podcast gives listeners access to information and educational content provided by discussing numerous financial sustainable options and our featured guests. It is not intended as a substitute for professional, legal, or tax advice. The hosts of The Greener Way are not financial professionals and are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.